Hey guys, what's up? I'm Erin and welcome back to the channel. If you're looking at your retirement accounts and you find that you have more traditional accounts or only traditional accounts, whereas you would prefer rather to have Roth accounts, you might want to consider a Roth conversion. A Roth conversion is a process where you move funds from a traditional retirement account, like a traditional IRA or 401k, into a Roth IRA. Now, why you might be interested in making this type of conversion might come down to tax planning considerations for your retirement years, or maybe it's simply that you want to be able to unlock these funds at an earlier date than, say, traditional retirement. Let's first look at these account types. When it comes to a traditional IRA, 401k account type like that, contributions are made on a pre-tax basis. So the year in which you make your contribution, it actually reduces your taxable income. Then this money gets to grow on a tax-deferred basis. Once you reach retirement and start to make your withdrawals, this withdrawal is taxed as ordinary income. On the other hand, when it comes to the Roth variety of these accounts, contributions are made on a post-tax basis, so money you've already paid income taxes on. Then this money gets to grow completely tax-free, and once you reach retirement, you can take your withdrawals without any sort of tax consequence. So if you decide to convert funds from a traditional account to a Roth account, you're making the decision to pay taxes today in order to avoid paying taxes down the road. The process of making this conversion is simply moving funds from your traditional account to a Roth account. And there's a lot of flexibility here. You can move a portion of the funds or you can move the account in its entirety. But the key thing to keep in mind is that moving funds from a traditional account to a Roth account is a taxable event. The amount converted is considered taxable income in the year of the conversion. So how it will be taxed depends on the income bracket you fall into. This is what the income tax brackets look like for this year, 2024. In the US, we have a progressive tax system. The tax rates increase as you move into higher brackets. The key thing to keep in mind is that only the income that falls within each bracket is taxed at that bracket's rate. So not all income is taxed at the highest rate. You end up paying what is called a marginal tax rate. So let's run a quick example on a straightforward Roth conversion. Let's say for our example, we have a married couple with a combined annual income of $100,000. Let's say one of the partners has a traditional 401k with $50,000 in it that they want to convert on over to a Roth account. If this couple were to make this conversion in 1 year, that $50,000 conversion would be taxed as ordinary income. Once we subtract the standard deduction of $27,700, their tax bill for the year would be about $17,000. If they had not executed this Roth conversion, their tax bill would have looked something like $8,000. So this couple does need to make sure that they have the additional $9,000 or so on hand to be able to fund this one-time conversion. However, this does mean that once they reach full retirement age, they would have more freedom on how they take withdrawals from this account, and any withdrawals would be made without any tax consequence in retirement. It's important to keep in mind that generally an early withdrawal from a traditional retirement account, anything before the age of 59.5, which is considered full retirement age, generally comes with a 10% penalty from the IRS. But keep in mind that a conversion is not the same thing as a withdrawal. If you do a conversion from a traditional to a Roth, that is not something subject to penalty. You just owe the income tax on it. What if instead of doing a one-time Roth conversion, we were to execute a Roth conversion ladder? A Roth conversion ladder is a strategic method of converting a traditional retirement account into a Roth IRA over several years. The concept involves systematically converting portions of a traditional IRA, 401k, or like account into a Roth IRA each year and then waiting 5 years before accessing those converted funds. Again, the goal of this type of conversion is generally to allow earlier access to these funds or greater flexibility with these funds in your retirement years. Let's say we have a couple whose current age is 50 each, and one partner has a traditional 401k that has $600,000 in it. Together, the couple has a combined household income of $100,000. And just in case you're wondering how plausible it would be to have $600,000 in an investment portfolio by the age of 50, one can get there by simply investing $425 a month over 30 years. So if you started at 20, this is a very realistic goal. Let's say that this couple is starting to plan out for their retirement. They're running a few calculations and they see that this traditional 401k could grow to over $4 million. Now, if you're wondering why I chose a 25-year time horizon here, that's because as of the year 2033, the Secure 2.0 Act has said that the required minimum distribution age will then be 75. So this is the longest they could leave that money invested without having to take distributions. At which point this couple would be forced to take a required minimum distribution on an account that has several $million in it. That, combined with Social Security and any other income sources, this couple is concerned that they very well may be in a higher tax bracket in their retirement years. To avoid paying taxes at a higher rate down the road, they want to convert this money from a traditional account to a Roth IRA today. First, let's assume that they want to stay in the 12% tax bracket. So an income of up to $94,300 after the standard deduction. Based on their current income, that means they could convert $22,000 a year. Say they continue this conversion amount each year for 12 years. Over the 12 years, they would have converted a total of $264,000. During this time, we are assuming their income remains the same and the standard deduction remains the same. The beauty of this conversion is that it's not an all or nothing approach. If you want to stay in the absolute lowest tax bracket possible, you can convert smaller amounts over a longer period of time. However, if your goal is to convert the account in its entirety, you would have to face the fact that you're going to owe higher taxes in the interim, but in the long run, then you wouldn't have a traditional account that would require RMDs or a traditional account that you would have to pay taxes on in retirement. So it really depends on what your priorities are. For instance, if this same couple wanted to convert their entire account and was willing to stay within, say, the 22% tax bracket, the conversion may look more like this. After accounting for the standard deduction, they would be able to convert a little bit over $128,000 on an annual basis and still stick within the 22% tax bracket. A conversion at this rate would likely have all of the funds transferred out of the traditional account and into a Roth within 5 years' time. Is this the best scenario? It depends. It depends on what tax bracket you think you're going to be in retirement. It depends on what your goals are with this account. Ultimately, the answer is always, it depends, and it depends on your personal situation. A good rule of thumb is to start the conversion process about 5 years before you're going to need these funds. There is a rule that once you convert funds from a traditional to a Roth, you have to leave it in the Roth completely untouched for 5 years. Once those 5 years pass, you can make withdrawals on the converted amount, though not any gains on the converted amount, prior to full retirement age of 59.5, penalty-free if you so choose. This can be a really creative way to fund an early retirement. For instance, let's say you have the goal of retiring at the age of 50. You could start a Roth conversion ladder starting at the age of 45, and this would allow you to have funds to access once you turn 50, even if they're in a retirement account. But just remember that the converted funds have to sit in that account for 5 years before you can access them completely penalty-free. Conversions are taxed at your current income rate. If you expect your income to be lower in the future, it may be advantageous to delay conversions or convert smaller amounts over a longer period of time. A very appealing perk of having funds in a Roth IRA rather than a traditional retirement account is once you hit full retirement age, qualified withdrawals are made without any sort of tax consequence. And this can be very appealing if you anticipate being in a higher tax bracket in retirement. And this is a very likely scenario for many who are aggressive savers and investors throughout their entire working career. I also think it's beneficial from a psychological standpoint. You can look at your account balance and know that that entire balance is yours to do with whatever you wish. You don't have to do this mental calculation of, okay, how much taxes do I have to pay once I make a withdrawal? How much do I owe the government? When it comes to giving yourself multiple accounts to draw on in retirement, this can give you diversification with your tax planning in retirement. Often when it comes to retirement, you hear about the different tax bucket, your taxable, your tax deferred, and your tax-free buckets. The taxable bucket would include things like income, investments in traditional brokerage accounts, which may be subject to advantageous tax treatment like long-term capital gains or dividend rates. The tax-deferred bucket is generally your traditional retirement accounts that are then taxed at ordinary income levels. And finally, the tax-free bucket, which are funds you get to withdraw without any tax consequence. Being able to have the flexibility to access different buckets at different times can greatly reduce your tax bill in your retirement years. An RMD, or a required minimum distribution, is a mandatory amount that the IRS mandates that a retiree take out of their traditional retirement account once they reach a certain age. A wonderful perk of Roth accounts is that since contributions are made on a post-tax basis, meaning money you've already paid taxes on, there's no incentive for the IRS to say, hey, it's time for you to make a withdrawal. There are no RMDs on Roth accounts, so you can let this money sit for as long as you want. There's no mandatory withdrawal of a specified amount at a specified time. These accounts come with a lot of freedom. And I did recently do a video on RMDs that I will link down below if you're interested in checking it out. Roth accounts can be particularly beneficial when it comes to planning on leaving funds and accounts to your heirs. As beneficiaries on these account types, they don't have to pay taxes on the inheritance of these funds. Roth accounts are still subject to the 10-year withdrawal rule. The 10-year withdrawal rule applies to non-spouse beneficiaries who inherit traditional or Roth retirement accounts. These funds must be withdrawn within 10 years of being inherited. However, beneficiaries do have to pay ordinary income tax on inherited traditional accounts, whereas they don't have a tax consequence when it comes to Roth accounts. As always, when I talk about the Roth and when I talk about the traditional accounts, I like to add that one is not necessarily better than the other. They both have great utility. In some circumstances, the Roth is better. In other circumstances, perhaps the traditional is better. It's really about figuring out what is best for your situation, and you want to make sure to do your own research. Leave your thoughts on the Roth and traditional accounts down below. Have you ever tried a Roth conversion, or is it something you're planning on doing in the future? Share your thoughts. I post new videos every single week. If you got anything at all out of this one, please give it a like. If you're new here, please consider subscribing, or if you know of someone who might get something out of this type of content, please consider sharing. I hope you have a great day. See you soon. Bye. Now why? Oh geez. Now look at these. Stupid. Forget one word and have to redo the whole thing. It's kind of an important word though. Avoid paying taxes in retirement years. Or, I don't like avoid paying. We should probably pay our taxes. We'll just work around.